Here we're going to look at some of the additional leading indicators. And with the first Fed entity to come out with data is always the U.S. Empire State. So we want to look at what are they saying, what are we seeing so far, and then what is that going to mean going forward when we start looking at some of the other data sets. So January Empire Manufacturing Index dropped into negative territory, coming at negative 0.7 versus 31.9 in the prior month. For the first time since June 2020, new orders responsible for most of the decline, coming at negative 5 versus 27.1. Prices paid and received ticked down along with employment while still in expanding territory. So we're starting to see some of these things go negative, which it may seem concerning, but when you consider what happens going into a seasonality point, you have to look at, well, okay, you had a very strong December. You had people that pulled forward buying in September, October. November, December was slower. And as we've been saying, we saw that trend continuing into January and February, and this just kind of confirms what we've been seeing. I still don't think it's leading to a perpetual down move. I don't think this is going to show that we're going to get negative growth in Q1. It's just showing that there's going to be a lot of pain in Q1 and that expectations are too high. And you're starting to see that come through because some of the more leading components like new orders responsible for most of the clients. So that the fact that new orders, what's coming in the future is what caused the biggest decline is a big problem. That's where we're going to see some of that pressure when we're looking at how things bleed, not only in just January and February, but going forward because new orders are down. So your backlog is shrinking, what you have to work on, which is also going to pull down some of those employment numbers. So then this is just giving an idea of where new orders are and what happens normally. So if you look at 2019, if you look at what happened in 2016, 2017, we normally get some of this dip at this period. It can happen in December or January or February, but it's seasonally normal. And that's why I'm not concerned yet. It's a matter of what comes in next month, and do other areas within the U.S. see something similar? Because then that'll lead to, this is something that we have to pay attention to. It's more than just a blip. It's something a bit more serious. And then this could lead, maybe we do get a Q1 decline. And that's where we're going to have to look very specifically as to what is happening at this point and where are things going to go as we head into the end of Q1 and beyond. But while all of that is happening, the U.S., the prices paid in 6 months is at a new all-time high, and prices received in 6 months is at a new all-time high. So again, leading to that inflationary conversation, but look at the difference. So prices paid coming in, let's call it 78, where when you look at prices received at about 63. So you still have that gap. And I don't see that gap closing. You're just going to see it level off on the prices paid, prices received, but you can still see a lot of inflationary pressure behind it, which then leads us back into, and I'm just going to keep kind of wrapping this in to try to build a broader picture for you, where flexible inflation per Atlanta Fed has surged 17.9% year over year as of December, now beyond 1980 peak of 16.7%. Sticky inflation, however, is running at 3.7% annual, fastest since 1992. And just looking at the data sets, it's going to say, look, that flexible, flatlining. But the sticky, that's where we're going to continue to see that those inputs driving higher. And now when you look at some of the backdrops on earnings, individuals in the lowest earning quartile, as tracked by the Atlanta Fed, as we showed in the last segment, continue to have very strong wage growth relative to high earners. 5.4% year over year is the fastest rate since March 2002. So as we said, 2014, very strong. But 2002 is the level that we're at right now to give you an idea of the growth. But look at the highest earning. It's just kind of turning up, but it's still down from pre-COVID levels. It's still struggling. And yes, a lowest earning quartile is going up, but let's consider what this means. So I used this example before. So say you have someone working at the Hyatt. They were employed throughout the COVID. They were making $15 an hour before COVID. Now, they maintain their employment. They, because of their due diligence and their work, they got a $2 raise. So let's say they went from $15 to $17. Now, as everything comes back, Marriott across the street is offering for the same job $21. So why am I going to stay with Hyatt if I can do the same job at $21? And that's where you're getting some of that bump. But they're incentivized to do it because their costs are going up. Their rent, their food, their gas to get to work. These inputs keep going up. So you're going to be incentivized to go to that next entity, which is why you're seeing that move back up. But that's going to start to flatline here as we get past February. Into February. But on the highest earnings side, that will catch up a bit, because think about people that are in high earning wage areas. So you don't quit your job till you get your bonus. So your bonus is either going to be paid out in December, January, or February. So you get your bonus and now you quit, and you will likely go to a place that's going to pay you more. So that will also help you kind of get that nice little bump. But then you're going to get some of that flatlining, because now when you look at when is hiring the best, it's March through May, especially for the highest earning side. So that's going to be realized, and then you're going to get a lot of that kind of stagnant move. And that's some of the pressure that we're seeing as we go forward. But when you look at just what is driving these different pieces, the one that we talk about the most is looking at that core piece, and how, yes, energy will come back down at some point. As the backwardation is getting steep to a point of over $10. You're starting to see some of this give and pushback, but it's going to leave that core piece up there and impact what real wages are going to look like. Again, speaking back to how much money are people going to have to spend. And then when you look at that, just kind of wrapping this into the U.S. Empire State Manufacturing Survey, it's also showing that there's that pressure for ISM manufacturing, where we're going to get that drop down. You're going to see that pressure. And it's going to be some things that, as we said the last few weeks, as the ISM numbers came out, that even though they came down below estimates, it wasn't bad reasons. You had, the supply chain picking up a bit, things accelerating, which is a net positive. But now when you look at what comes next, when you're starting to look at, new orders are coming down, that's a negative. That's a negative data point going forward. So we want to look at, if ISM manufacturing does follow the U.S. Empire State Manufacturing Survey, why did it follow? Is it for reasons where the supply chain is catching up a bit, which just means things will get a bit better? Or are we starting to see slowdowns? And that's going to be, I think, a big thing that we're going to want to continue to watch. And this is what we've been talking about with the U.S. Real Average Hourly Earning Index coming in right on point and coming now just below the trend. And that's something that we see continuing for the next week or for the next month or two. And now when we look at adjusted retail and food sales, so retail sales much weaker in December, came in at negative 1.9% versus the negative 0.1% estimate. In November was revised down. So, but look at the nominal amount. So this is looking at the dollar value. So we know inflation is there. So now not only is volume down, but the value is down. And that's the pressure that we've been talking about. We thought it was gonna kick off in October. Instead, we were going to get something in September, get a nice little surge in October for Christmas, and then you were going to see an accelerating down move in November and December. And so we were wrong on September, but we were dead right on where October, November, December is going to be. And we think that this is going to continue in January and February, keeping that downward move. Now, I don't think it goes much below. Let's just use 600 billion at this point. But you're seeing that pressure point, and that's going to bring the monthly totals down. And again, that's just going to cap where growth is, which is where we see some of these pressure points when we're speaking about demand. And this just gives you a taste of where. So when you look at retail sales in December, you have building materials, which were higher, as we're talking about, remember, building starts versus completions, health and personal care, miscellaneous stores. But some of the other things that we've been seeing, food and beverage, general merchandise stores, and then some of the ones that we saw that the higher end side, as people, how many TVs do you buy in a year, and you get a nice paycheck from the government, so let's go buy what we've been putting off. So that's when we continue to see some of these pull downs in retail and core retail sales, which we don't think is going, we think we're going to get another reading as we go through January and February. And then, but that also has a positive indication for a piece. And the reason why is when you look at inventory sales ratios. So as retail sales slow, and then the supply chain catches up a bit, that allows inventories to catch up a touch, which it provides a bit of a buffer if you consider where the supply chain is, which is why it's not going to be the same type of impact right away. We think it'll get worse again, just given the issues that are happening in China, the issues that are happening with COVID, and some of the things on the coast. But you'll have a little bit of a buffer at this point versus some of the other waves, which will help insulate a bit. And that's why when you look at global manufacturing PMI delivery times and prices, you're starting to see some of those movements where the replenishing is coming in. But there's a negative end to that where the consumer is also slowing, so they're buying a little bit less, but the supply chain's catching up. So it's kind of that catch-22, and depending on where you sit on which one's bigger, if the inventory increases more than consumer sales fall, then it's a net positive to GDP growth. So you have to look at, where are some of these pieces moving, and are they moving in a positive or negative direction? So now when we look at U.S. business inventory to sales, you get an idea that it's different on overall level. So wholesale getting a bit better, manufacturing, retail a little bit of a bounce. But again, these are some of those key pieces that we want to continue to look at and understand in terms of where the consumer is sitting on strength. Now, December housing starts came in at positive 1.4% versus the negative 1.7%, where when we look at November, it was revised down from 11.8% to 8.1%. So we had some of that being delayed from November into December. Again, do you have the equipment to start? Do you have the inventory? Do you have the raw materials? Building permits came in at positive 9.1% versus negative 0.8%. Housing completions, on the other hand, came in at negative 8.7% versus 13% prior. So you're getting, again, starts are there, but completions aren't. And that's where we continue to see some of this disconnect given just availability and what is on the market, which is why home buyer demand hasn't faded yet. Data so far in January showing home buyer demand index is up 22% year over year. Stage is set for the most competitive January in housing market history. This is a nice positive. One of the things that we were expecting was to have a nice little start, but then as bonds do what they're doing, you're starting to see some of this concern around equities. That's when you start to see this slowdown, and then that's going to be a bigger draw and bigger pull, and that's going to result in a little less activity, especially as that incremental buyer goes away. The only way this could adjust, if we look at the demand side, is some of these foreclosures. If they come out, if people have been waiting for some prices to come down, then all of a sudden they may get rejuvenated and they may come back into the market. But when you look at forecast on apartment rents are going back up, which means that people are opting to stay in their apartments for another year, which again gives us a bit more confidence that you're going to get some of that drawdown in that housing demand. The apartment list estimates, and then if you look at the CPI, owner's equivalent rent, all the reasons, again, leading us back to that sticky side, that's going to increase the inflationary pressure and keep us fairly well elevated on the sticky inflation front, especially as the CPI OER catches up to where rents currently sit and where I think rents will remain. The 30-year fixed rate mortgage average in the U.S. spiked. This is also going to cool off the amount of buying that people are willing to do. And again, that's the other piece that I think is missing is, well, people are looking at the cost of the homes, and they're like, you know what, this is foolish, I'm waiting. And now mortgage rates are going up, which I think is the additional slowdown that we've been talking about and will remain an underlying issue. which is why when we look at the University of Michigan sentiment continuing to move lower, as we said previously, and this is looking at not only the index, but also the expectations. Now, industrial production was slightly weaker, which again kind of echoes what we saw with the U.S. Empire Index. When you look at what the expectations were, December came in at negative 1% versus the estimate of 0.2%, a positive 0.2%. So a little bit of a slowdown, but again, nothing too meaningful. But as those new orders slow, that's where we think industrial production is going to accelerate to the downside as we go through January and February, also putting a cap on some of that inflation that we've been talking about. So that's what we have for you for the rest of the U.S. Now, in the next segment, we're going to go into Europe. It hasn't been a huge amount of data, so this segment will also be brief, and then we'll go deeper into China and Asia, but specifically China and some of the issues that we've seen, or what the underlying of the GDP numbers really mean going into 2022.